Hey everyone, Emily is here. Wall Street just sent a warning shot. Goldman Sachs and Morgan Stanley, two of the biggest names in global finance, are now calling out overheated tech valuations and predicting a market pullback. And on the same day, Palantir, the AI poster child, reported record profits, but its stock still crashed. So what's really happening beneath the surface of the S&P 500? Let's unpack the fear, the facts, and the future. The markets turned red on Tuesday. At midday, the S&P 500 fell 1%, the Nasdaq tumbled 1.75%, and the Dow dropped 266 points. Why? Because investors suddenly started to question whether tech stocks have gone too far, too fast. After all, the S&P 500's massive rally this year was fueled almost entirely by AI optimism, and now, even Wall Street's top executives are saying it might be time to cool off. Let's start with the warnings. Morgan Stanley CEO Ted Pick said he expects a 10 to 15% drawdown in the market, not because of a crisis, but because valuations are stretched. Meanwhile, Goldman Sachs CEO David Solomon added that technology multiples are full, meaning investors are paying extreme prices for future growth that might not materialize. When these two CEOs, usually cautious and reserved, speak this bluntly, markets listen. And today, they reacted instantly. This warning didn't come out of nowhere. The U.S. manufacturing sector has now been in contraction for 8 straight months. The ISM index just came in at 48.7, below the 50 mark that separates growth from decline. And because of the ongoing government shutdown, key economic data, like employment and inflation reports, aren't even being published. That leaves both investors and the Federal Reserve flying blind. Fed Chair Jerome Powell suggested the last rate cut might be the final one this year, but Mary Daly and Lisa Cook hinted that another cut could still come in December. So we're stuck in a strange limbo, a slowing economy, uncertain data, and mixed signals from the Fed. Now let's talk about the tech sector, the center of this storm. Palantir Technologies just delivered another record quarter. Revenue, $1.18 billion. Net profit, $475.6 million. CEO Alex Karp proudly said, "We're now making more profit in a single quarter than we used to in revenue not long ago." And yet, the stock fell. Why? Because investors were already pricing in perfection. When expectations reach the sky, even great results can disappoint. Palantir's forecast was solid, but investors wanted spectacular. Next up, AMD. The chipmaker is set to report earnings after the closing bell. Last month, AMD announced a multi-year deal to supply AI chips to OpenAI in exchange for revenue worth billions, and possibly a 10% stake in OpenAI. That's massive. But again, expectations are sky high. Investors are watching whether AMD can match NVIDIA's explosive momentum, or if it'll remain the AI underdog of 2025. Outside of AI, we're seeing a mixed corporate picture. Uber beat earnings but issued soft guidance. The stock fell. Yum! Brands jumped after announcing a strategic review of its Pizza Hut division, and Marriott rose on strong demand for luxury hotels, even as budget bookings weakened. So across the market, investors are rotating, pulling out of high-risk tech and leaning into steady cash flow names. That's what a correction looks like in slow motion. Here's the big takeaway. This isn't 2000. We're not seeing dot-com level insanity, but valuations, especially in AI, have gone parabolic. When even the CEOs of Goldman and Morgan Stanley start saying it's full, it's a signal. Take profits, rebalance, and don't chase every shiny AI stock that pops up on your feed. A 10 to 15% correction might sound scary, but it could also be healthy. It's what resets expectations and prepares markets for the next real rally. Corrections aren't crashes, they're reality checks. And sometimes, reality is exactly what the market needs to grow stronger. If you're a long-term investor, don't fear the red, use it. Because in every downturn, someone's quietly building the next bull market. The markets are adjusting. not collapsing. Every correction feels uncomfortable, but it's how the system breathes. Goldman and Morgan Stanley's warnings aren't about panic. They're about perspective. If valuations are stretched, trimming the excess can actually make the next rally more sustainable. We've seen this pattern again and again. A surge of optimism, a brief pause, and then a new foundation for growth. So take a step back, stay analytical, and remember, the smartest investors aren't the ones who predict the storm. They're the ones who build when the clouds clear.